Okay, let's see. What's up, guys? Welcome back. So, made it to the library. Have about an hour and a half before this place closes. But I want to take a break from the Excel stuff and do some reading. So I got this book called Corporate Lifecycles by Swath Modern, one of the NYU professors of finance. And I thought it's pretty good. Talks about his framework of thinking about corporations through this life cycle, sort of like a human life cycle. Baby to kid, to teen, to young adult, to a mature sort of adult, to aging, and then eventually, and unfortunately, death. I think that's just how the nature of corporations have evolved, I guess, throughout time. Sort of similar to how a human life cycle works. Okay, so let's go through these flashcards. How many main sections are there, and what are they? So there's, I remember, 5 main sections. First is just an at a glance how the corporate life cycle works. Second is I believe a look at how do you invest and price companies at different parts of the life cycle. The third is the philosophies of those investments throughout the life cycle. The fourth then is how do you best manage across the life cycle? So what are the things that you need to do operationally? And I think I'm missing one. So I said valuation and pricing, at a glance, investing philosophies, and then also managing. So it's corporate finance, right? Okay. Corporate finance across life cycle. The 3 key factors that the modern evaluates at all the business stages across the corporate life cycle. Explain them briefly. Okay, so honestly, the 3 key factors are 1, the business challenges, 2, the financial profile, and then number 3, the capital and ownership challenges that a company faces. So business challenge, what do you need to do operationally? What do you need to focus on? For example, with startups, they need to focus on product development. That's their main goal. They need to convert their ideas into an actual product that they can then sell. That could change. So when you're a young growth company, then you have to take that product that you've made as a startup and then try to monetize that somehow. That should be the main focus for the business itself operationally. If you think about the financial picture, the financial picture is really, okay, what are the revenues? What are the expenses? What are the costs? And how do you optimize growing your revenues or reducing your expenses, or maybe figuring out what type of business model or cost structure you're going to have. If you want to focus on fixed costs, which I think is what Netflix does, they try to produce their content themselves and then amortize that cost across millions of subscriptions across the US. Spotify, on the other hand, has this variable pricing business cost, where instead of creating their own music content, I think what they're essentially doing is they're licensing and they're paying record labels a variable portion based on how much of that music is consumed. So if you're listening to an hour of Drake, then you pay Drake's record label an hour's worth of royalties of licensing fees. If it's 2 hours, pay 2 hours worth of licensing payment fees. So that is very different from Netflix, because now when Netflix tries to scale, they have this operating leverage where they can build once, amortize it across, but as Spotify scales, they have to actually face the same increase in costs for an increase in revenues. So that's kind of like the financial picture. The final one, ownership and capital challenges. So that is really what are the ownership control structures you want to put in place. You want the founder to run the business, or do you want someone maybe more seasoned to run the business? How do you structure decisions to be made, and how do you think about succession planning? Simultaneously, you have to think about, okay, with this ownership comes sacrifices. If I want to raise capital, I'm going to have to reduce my ownership as a founder or my ownership as an investor. If I want to raise more capital, inject more capital into the business, because effectively you're selling shares in order to do that. So those are the three main ones, the three main factors to think about. Okay. How many phases does the modern break the life cycle into? What are they, and what is the high-level description of the business in those phases? Okay, so 6 of those phases. First one is startup. Second is young growth. Third is high growth. Fourth is stable growth. Fourth is mature stable. And then, that's fifth. And 6 is a decline. So startup, young growth, high growth, mature stable, and then decline. Okay, high-level description. Startup. This business, pre-revenue, or maybe making very little revenue. Their goal is to take this business idea. Maybe they want to create a perfume, some type of software, and then actually convert that into a sellable product. Young growth is, okay, you have this product now in the startup phase that you've developed. Now it's a matter of how do you monetize that? And then turn that into a viable business model. And maybe try to scale a little bit. But that's where the high growth phase really comes in. You have this business model in place and you really want to grow and scale. Fourth is mature growth, where I think you focus on entering new markets and defending your growth from competitors. And I think that's the same with mature stable. You kind of have this consistent growth, maybe lower growth that's similar to the growth of the economy. And I think this is where you tend to pay out. You have a lot more capital than you can really invest back into the business. With the high growth phase and mature growth, I would say maybe it's more so the mature growth phase, you tend to have a faster increase in your earnings compared to your revenues. And I think that might be the same for a high growth phase as well. And then decline, you tend to have negative growth rates for your business. And the goal here is to figure out, okay, one, how do you reinvent yourself? Or maybe two, what do you need to do to sell off the assets in order to compensate the investors? Determine what the ceiling is given market size, competition, and capital earnings. So startup phase, young growth phase, high growth phase, mature growth phase, mature stability phase, decline, and stress. Work on improving profit margins, allowing revenue growth. Allowing earnings to grow faster than revenues. Okay. So what are the business challenges companies face in the startup phase? What are some data points to back this up? Okay. So I want to say there's a few business challenges what Damodar focuses on is, main thing is converting your business idea into a viable product. So the main operational focus for this company in the startup phase is product development. And then you'll have this challenge where this company is just burning through cash. A startup company tends to try to develop revenues, but their costs or their expenses are rising faster than their revenues. So common costs could be marketing, product development, which should be the main one, research and development, and then payroll expenses. Actually hiring the people, right? Which could fall into maybe product development costs. Yeah, your costs tend to rise faster, to scale faster than your actual revenues. And so this requires a lot of founders to then need to raise capital in order to sustain and provide care for their company. So this is probably one of the hardest parts, or it's the gatekeeper of building a business. I think what Damodar provides as some evidence to back his claim up is a graph, and I think some charts from the Bureau of Labor Statistics that shows 75% of all startups in the US fail after just 15 years. Usually in the first year, about 20%, 25% of all startups, or at least new business application companies that have filed to be a business, they all fail. And cumulatively, that tends to grow into 75%, but marginally, year over year, that number, that decline rate tends to decrease. Let's pass to the registration, please. Okay, yeah, so going back to what we talked about earlier, the financial picture, low revenues or even no revenues, rising costs, marketing, payroll, research and development, product development. So you have this cash burn, and the company, the startup, is essentially this baby that needs capital, it needs care, and it needs attention. I think that will flow into the capital and ownership challenges, and that's where a lot of the VCs and angel investors come into play to help provide that care, to provide the capital, and to provide the attention. And then I want to say that there's one thing to note. I think spending here, it's key to focus on product development. That is the main focus that Damodar thinks you should focus on. I said focus like 5-6 times. But there's cases where startups will raise some money and focus their spending on marketing or an upscale office or free lunches. Some of that's nice, it could boost company morale, but at the end of the day, if product development is not your main focus, then it's likely you actually won't create a viable and differentiated product. Spending also is really a function of two variables, according to Damodar. One is sort of the market size or the market potential. If you think that the market potential in which your company is trying to enter, if you have some solution for $1 trillion market opportunity, you're actually going to probably be willing to spend more money in order to build that product compared to a product where the market potential is maybe $1 million or $1 billion. That's variable number one. Variable number two is usually the founder's ambition. Usually, if you have a founder that is more ambitious, that has larger dreams, larger targets, they will tend to spend more in order to reach their target. So take those two things. Spending is a function of two big variables. Companies, startups, they're cash burners, and so that's 1 and 2. And number 3 is focus your spending on product development. Okay, well, I guess I did write this here. I think it could depend on the product, right? So I saw this, like, see Liquid Death as an example, where Liquid Death is just straight up a water bottle or water in a can brand. So I guess you could say design of the can is probably product development, but they spend a bunch of money on marketing. And I think that actually does help. And I think they did that with some type of alcohol brand. I forgot what it was called. Maybe Tito's. So look that one up. Cardi. Oh, I think it was Casamigos. That's interesting. Two variables, shopper. Market potential, bigger market. Okay. We're spending on that dream. Yes. How many sections are there? And what are they in the corporate life cycle? So there's 5 main sections. Number 1 is at a glance, corporate life cycle. Number 2 is corporate finance, the corporate life cycle. Number 3 is valuation and pricing on the corporate life cycle. Number 4 is investing philosophies. Number 5 is managerial decisions. Capital and ownership challenges for companies in the startup phase. Right, I think the capital and ownership challenges really come up with startups, with companies in the startup phase. Trying to think. I just kind of got lost in thought for a sec. But capital and ownership companies, startup phase. I think one is the idea of, okay, you need money essentially. Keeping with the life cycle analogy, a startup is a baby. It's a baby with a very high mortality rate. What does a baby need? It needs care, it needs attention. In this case, with a company, with a startup, it needs care and attention, and it needs capital. Capital is the food for startups, like nutrition is for the food for babies. Who are the providers of this care, attention, capital? It's VCs and angel investors. These guys have the expertise, they have the knowledge, usually of the sector, the business in which the startup is operating in, and they have a boatload of money thanks to pension plans, foundations, endowments that are looking for some high returns and exposure in the US startup ecosystem. So raising capital is one of those challenges, but thankfully the US has one of the greatest, I think most active startup culture, and I think that's why a lot of companies in the US, if you look at where startups are concentrated, it has been concentrated in the United States. Number two is, okay, you have to think about when you're raising this money, when you're feeding yourself, you have to figure out what is the trade-off I'm willing to make with raising money, but also sacrificing ownership of my company as a founder. And it's usually during the early stages, pre-seed, seed, Series A, rounds of financing where you are sacrificing the majority of, I wouldn't say the majority, but you are sacrificing the most relative to later rounds of your equity in this business. The companies, the VCs that are investing at this stage are taking a big risk, so they want more of your company than at the later stage where your business model, potentially you're in a young growth to a high growth stage, your business model has been proved, you have a product, it's found your product market fit, and now you're just looking to scale. And survive and to grow. So what are the Draft's data points that Limiter tracks for startups to create his profile of the numbers, founders' effects, business challenges, financial picture, and capital plus ownership challenges? Okay, so I want to say he has a distribution of geography, number of startups founded. He also has the age of the founders. He found cumulative and marginal failure rates for new business applications. And then VC deal making. That's 5 so far. VC deal making across different geographies. And I want to say like a breakdown of the new business failure rates by time and then also by sector. Sector. Okay, so young growth companies. Yeah, this is, I think, where we left off last time. So business challenges that young growth companies face. I want to say the main ones here are, now that you have your product that you've developed in your startup phase, now it's a matter of actually monetizing that, being able to distribute it in stores or sell it to businesses or consumers. So that's the main problem you're trying to face here. Converting your idea into a viable business. Create a business model which is just a structure of monetizing or a plan to monetize, a way of monetizing your products or service. And then I guess refining your business or your product to meet that product market fit. Yeah, it's interesting. The capital challenges. Okay, Okay, so this is where we left off. And I'm going to edit some stuff here. Hello. I'm streaming right now. I could end it real quick. But no one's watching. You're forever imprinted on my channel now. Okay, 27 minutes.